Question 1. A registered representative is discussing investment options with a client who is primarily seeking tax-exempt income. Which of the following investments would be most suitable for this client? A. Common stock of a growth company. B. Corporate bonds with a high yield. C. Municipal bonds. D. Preferred stock with a cumulative feature. Answer: C. Municipal bonds. For a client primarily seeking tax-exempt income, municipal bonds are the most suitable investment because the interest earned on these bonds is generally exempt from federal income tax and often from state and local taxes if the investor resides in the issuing municipality. Common stock, corporate bonds, and preferred stock all typically generate taxable income, making them less appropriate for this specific client objective. Remember, municipal often signals tax benefits for investors, especially regarding income. Question 2. Which of the following statements is true regarding a callable bond? A. It allows the bondholder to convert the bond into shares of common stock. B. It gives the issuer the right to redeem the bond before maturity. C. It provides the bondholder with a fixed interest rate that adjusts based on a benchmark. D. It obligates the issuer to repurchase the bond from the bondholder at a predetermined price. Answer: B. It gives the issuer the right to redeem the bond before maturity. A callable bond features a call provision, which grants the issuer the option to buy back the bond from bondholders before its scheduled maturity date, typically at a specified call price. Issuers often exercise this right when interest rates decline, allowing them to refinance their debt at a lower cost. Understanding callable bonds is crucial as they carry reinvestment risk for the investor, who may need to find a new investment for their principal at a potentially lower interest rate. Question 3. Under the Uniform Gift to Minors Act, UGMA, or Uniform Transfers to Minors Act, UTMA, who is responsible for paying the taxes on the income generated by the account? A. The custodian. B. The donor. C. The minor. D. The parent or legal guardian. Answer: C. The minor. In UGMA and UTMA accounts, while a custodian manages the assets until the minor reaches the age of majority, the property in the account is irrevocably considered the minor's. Therefore, the income generated from the assets in the account is taxable to the minor, typically at the minor's tax rate, though the kiddie tax rules may apply to unearned income above a certain threshold. It is important to remember that these accounts are distinct from trusts, and the minor is the legal owner for tax purposes. Question 4. A client places an order to buy 500 shares of XYZ stock at a specific price, and wants the order to remain active until it is executed or cancelled. This describes which type of order? A. A market order. B. A good till cancelled, GTC, order. C. An all or none, AON, order. D. A fill or kill, FOK, order. Answer: B. A good till cancelled, GTC, order. A good till cancelled, GTC, order remains in effect until it is either executed or explicitly cancelled by the customer. This contrasts with a day order, which automatically expires at the end of the trading day if not executed. GTC orders are useful for investors who want to set a specific price but are not constantly monitoring the market, ensuring their desired price is met whenever the opportunity arises. Remember that GTC orders must be re-entered periodically, typically every 60 or 90 days, as they don't last forever. Question 5. In a new margin account, if a customer purchases $12,000 worth of fully marginable common stock, what is the minimum deposit required under Regulation T? A. $2,000. B. $5,000. C. $6,000. D. $12,000. Answer: C. $6,000. Regulation T, set by the Federal Reserve Board, dictates that the initial margin requirement for equity securities is 50% of the purchase price. Therefore, for a $12,000 purchase, the client is required to deposit 50% of that amount, which is $6,000. While FINRA and NYSE rules also have a minimum maintenance requirement of $2,000 or 100% of the purchase price, whichever is less, Regulation T specifically governs the initial deposit for the transaction. Always remember that for initial purchases in a margin account, Reg T's 50% rule is paramount. Question 6. An investor who is concerned about capital appreciation but also wants to receive a regular, predictable income stream might find which of the following most appealing? A. Zero-coupon bonds. B. Growth stocks. C. Convertible preferred stock. D. High-yield municipal bonds. Answer: C. Convertible preferred stock. Convertible preferred stock offers investors a hybrid benefit, a fixed dividend payment, similar to traditional preferred stock, providing a regular income stream, and the potential for capital appreciation through the conversion feature. This allows the holder to convert the preferred shares into a predetermined number of common shares, benefiting if the common stock's price rises. Zero-coupon bonds offer no income, growth stocks focus on appreciation without predictable income, and high-yield municipal bonds prioritize tax-exempt income over capital appreciation. Question 7. Which of the following describes the primary role of a designated market maker, DMM, on the NYSE? A. To execute all customer orders, regardless of size or type. B. To act as an agent for institutional investors seeking block trades. C. To maintain a fair and orderly market in specific securities. D. To provide research reports and investment recommendations to clients. Answer: C. To maintain a fair and orderly market in specific securities. A designated market maker, DMM, formerly known as a specialist, is responsible for maintaining a fair and orderly market for the securities they are assigned. This involves providing liquidity by standing ready to buy or sell securities from their own account if there are no willing buyers or sellers, thereby narrowing the bid-ask spread and reducing price volatility. The DMM's role is critical to the smooth functioning of the exchange and ensuring efficient price discovery. Question 8. A client has an options position that they wish to hold until expiration, but they are concerned about the possibility of an assignment notice on their uncovered short call option. What is the latest time on the expiration date that an option holder can exercise their option? A. 12 p.m. Eastern Time. B. 3 p.m. Eastern Time. C. 5:30 p.m. Eastern Time. D. 11:59 p.m. Eastern Time. Answer: C. 5:30 p.m. Eastern Time. While options trading typically ceases at 4 p.m. Eastern Time on the third Friday of the expiration month, the Options Clearing Corporation, OCC, sets the cutoff time for exercise instructions to be submitted by the broker-dealer to the OCC as 5:30 p.m. Eastern Time on the expiration date. This allows broker-dealers time to process and submit exercise notices from their clients. Remember that firm cutoff times may be earlier than the OCC deadline to ensure timely submission. Question 9. An investor who is concerned about inflation risk would find which of the following investments most appropriate? A. Fixed annuities. B. Treasury inflation-protected securities, TIPS. C. Long-term corporate bonds. D. Certificates of deposit, CDs. Answer: B. Treasury inflation-protected securities, TIPS. Treasury inflation-protected securities, TIPS, are debt instruments issued by the U.S. Treasury designed specifically to protect investors from inflation. Their principal value adjusts semi-annually based on changes in the Consumer Price Index, CPI, and the interest payments also increase as the principal adjusts upwards. This built-in inflation protection makes TIPS ideal for investors concerned about purchasing power erosion. Fixed annuities, long-term bonds, and CDs offer fixed returns that can be negatively impacted by rising inflation. Question 10. A registered representative must explain the concept of net asset value, NAV, to a client investing in a mutual fund. The NAV of a mutual fund share is calculated: A. Daily, at the close of the NYSE. B. Weekly, based on the average price of its holdings. C. Monthly, factoring in all sales charges. D. At the time of purchase or redemption. Answer: A. Daily, at the close of the NYSE. The net asset value, NAV, of a mutual fund share is calculated once per business day, typically at the close of the New York Stock Exchange, NYSE, which is 4 p.m. Eastern Time. This calculation involves subtracting the fund's liabilities from its total assets and then dividing by the number of outstanding shares. Investors who place orders for mutual fund shares during the day will receive the NAV that is calculated at the end of that day. Question 11. Which of the following is not a characteristic of a money market instrument? A. Short-term maturity. B. High liquidity. C. Exempt from federal income tax. D. Low credit risk. Answer: C. Exempt from federal income tax. Money market instruments are short-term, highly liquid debt instruments generally considered to have low credit risk, such as commercial paper, treasury bills, and bankers' acceptances. While they are very safe and liquid, they are not inherently exempt from federal income tax. Interest earned on most money market instruments is subject to federal income tax, with the exception of municipal money market instruments. It's important to distinguish between the general characteristics of the money market and specific tax treatment. Question 12. A customer wants to open an account with her broker-dealer that will allow her to execute trades and also allow her sister to withdraw cash from the account. Which account type would be most appropriate? A. Joint tenants with right of survivorship, JTROs. B. Tenancy in common, TIC. C. A joint account with limited power of attorney for the sister. D. A regular cash account with the sister listed as a trusted contact. Answer: C. A joint account with limited power of attorney for the sister. A joint account, whether JTROs or TIC, would typically allow both account holders to trade and withdraw. However, if the customer wants her sister to have withdrawal privileges but not necessarily be a full co-owner with equal rights, which is implied by the phrasing, allow her sister to withdraw cash, a limited power of attorney would grant the sister the specific right to withdraw funds without necessarily having trading authority or ownership rights. This allows for tailored access without full co-ownership responsibilities, which might not be desired. Question 13. Which of the following would be considered non-public personal information of a customer according to Regulation SP? A. Information contained in a publicly available directory. B. Information the customer has provided on an application. C. Information from a publicly recorded mortgage document. D. Information from a website that is available to the general public. Answer: B. Information the customer has provided on an application. Regulation SP, established by the SEC, requires financial institutions to provide privacy notices to customers about their information sharing policies and practices. Non-public personal information includes data provided by the customer on applications, account balances, transaction history, and information derived from interactions with the firm. Publicly available information, such as directory listings or public records, is specifically excluded from this definition. Question 14. In a corporate election, a shareholder owning 100 shares of common stock wishing to cast all their votes for a single candidate for director would utilize which voting method? A. Cumulative voting. B. Statutory voting. C. Proxy voting. D. Majority voting. Answer: A. Cumulative voting. Cumulative voting is a method that benefits smaller shareholders by allowing them to concentrate their total votes for one or more candidates. If a shareholder owns 100 shares and there are 3 director positions up for election, they would have 300 total votes, 100 shares x 3 positions, and could cast all 300 votes for a single candidate. In contrast, statutory voting requires shareholders to cast a separate vote for each position, making it harder for minority shareholders to elect their preferred candidate. Many states permit corporations to choose between these two methods. Question 15. All of the following are typically characteristics of a variable annuity except: A. Payments received during retirement are tax-deferred until withdrawal. B. The payout is determined by the performance of the separate account. C. The investor assumes the investment risk. D. The principal value is guaranteed by the issuing insurance company. Answer: D. The principal value is guaranteed by the issuing insurance company. Variable annuities are investment vehicles that allow investors to participate in market growth, with the value of the annuity units and the eventual payout fluctuating based on the performance of the underlying separate account. This means the investor bears the investment risk, and the principal value is not guaranteed by the issuing insurance company. While payments grow tax-deferred, and the payout value changes, the lack of principal guarantee is a key distinction from fixed annuities. Question 16. Which of the following U.S. Treasury securities is generally quoted in 32 NDS? A. Treasury bills, T-bills. B. Treasury notes, T-notes. C. Treasury bonds, T-bonds. D. Both Treasury notes and Treasury bonds. Answer: D. Both Treasury notes and Treasury bonds. Treasury notes and Treasury bonds, which are intermediate to long-term debt instruments, are quoted as a percentage of par in 32 NDS of a point. For example, a quote of 101:16 means 101 and 16/32% of par. Treasury bills, on the other hand, are short-term instruments quoted on a discounted yield basis. Understanding bond quotations is essential for deciphering prices in the debt markets. Question 17. An associated person must complete the regulatory element of their continuing education, CE, requirement how often? A. Annually. B. Every 2 years. C. Every 3 years. D. Every 5 years. Answer: B. Every 2 years. FINRA rules require registered persons to complete the regulatory element of their continuing education, CE, program periodically. This element must be completed within 120 days of the second anniversary of their initial registration and every 3 years thereafter for as long as they remain registered. Therefore, the frequency is every 2 years for the initial requirement, then every 3 years. Question 18. An investor buys one XYZ Jan 50 call for a premium of $3. What is the break-even point for this options position? A. $47. B. $50. C. $53. D. $55. Answer: C. $53. For a long call option, the break-even point is calculated by adding the premium paid to the strike price. In this case, the strike price is $50 and the premium is $3, so the break-even point is $50 plus $3 equals $53. This means the stock price must rise to at least $53 for the investor to recoup the cost of the option and begin to profit. Remember that for calls, you add the premium to the strike price to find your break-even. Question 19. A registered representative is opening a new account for a client. Under FINRA rules, all of the following information must be obtained to open the account except: A. The customer's date of birth. B. The customer's employment status. C. The customer's social security number or taxpayer identification number. D. The customer's educational background. Answer: D. The customer's educational background. When opening a new account, FINRA rules require broker-dealers to collect essential information to verify the customer's identity and determine suitability. This includes the customer's name, address, date of birth, social security number, or TN, and employment status. While a customer's educational background might be interesting, it is not a mandatory piece of information required by FINRA for account opening purposes. Question 20. Which of the following statements regarding American Depository Receipts, ADRs, is true? A. ADRs are typically issued in denominations of a single share of the underlying foreign stock. B. ADRs are debt instruments that pay a fixed interest rate. C. ADRs facilitate the trading of foreign securities in the U.S. markets. D. Dividends paid on ADRs are exempt from U.S. income tax. Answer: C. ADRs facilitate the trading of foreign securities in the U.S. markets. American Depository Receipts, ADRs, are certificates issued by U.S. banks that represent shares of a foreign company's stock. They are denominated in U.S. dollars and trade on U.S. stock exchanges or over-the-counter, making it easier for U.S. investors to invest in foreign companies without having to deal with foreign currency or exchange regulations. Dividends on ADRs are subject to U.S. income tax, and they are equity, not debt instruments. Question 21. Which of the following would be considered a restricted person under FINRA Rule 5130, and thus generally prohibited from purchasing a new issue equity IPO? A. The aunt of a registered representative who works at a different broker-dealer. B. A portfolio manager of a mutual fund that participates in IPOs for their fund. C. A registered representative of the managing underwriter of the IPO. D. A public school teacher who is a casual investor. Answer: C. A registered representative of the managing underwriter of the IPO. FINRA Rule 5130 aims to ensure that public offerings are made available to the public and not disproportionately allocated to industry insiders. A restricted person includes broker-dealers, their employees, including a registered representative of any broker-dealer, especially one involved in the IPO, and certain immediate family members of such employees. The rule prevents spinning and free-riding and withholding. Question 22. A customer wants to buy shares of an exchange-traded fund, ETF. How are ETFs typically priced throughout the trading day? A. Based on their net asset value, NAV, calculated once a day at market close. B. Continuously throughout the trading day, based on supply and demand. C. At a fixed price determined by the fund sponsor. D. Only at the beginning of the trading day. Answer: B. Continuously throughout the trading day, based on supply and demand. Unlike mutual funds, which are priced once daily at their net asset value, NAV, after the market closes, exchange-traded funds, ETFs, are traded like stocks on exchanges. This means their price fluctuates throughout the trading day based on prevailing supply and demand in the market, often trading at a slight premium or discount to their underlying NAV. This continuous pricing offers investors more flexibility for entry and exit points. Question 23. An investor places a GTC, good till cancelled, sell stop order for 100 shares of XYZ at $45. If the stock gaps down from $46 to $44 at the market open, at what price will the order likely execute? A. Exactly $45. B. $46. C. $44 or lower. D. The investor's order will not execute. Answer: C. $44 or lower. A sell stop order is triggered when the market price falls to or below the stop price. Once triggered, it becomes a market order. If XYZ stock gaps down from $46 to $44, the stop price of $45 is bypassed, and the order converts to a market order. This market order will then execute immediately at the next available price, which in this scenario, would be $44 or potentially lower if the price continues to fall rapidly. Question 24. A customer wishes to invest in an illiquid security that offers direct pass-through of income and losses, significant tax deductions, and limited liability. Which of the following investments best fits this description? A. A real estate investment trust, REIT. B. A limited partnership, LP. C. A closed-end management company. D. An exchange-traded fund, ETF. Answer, B. A limited partnership, LP. Limited partnerships, LPs, are direct participation programs, DPPs, known for their illiquidity, direct pass-through of income and losses to investors, and the ability to generate significant tax deductions or credits. Importantly, the limited partners benefit from limited liability, meaning their potential loss is restricted to their investment. REITs, closed-end funds, and ETFs are typically liquid, do not offer direct pass-through of losses, and do not provide the same level of tax deductions. Question 25. Which of the following is considered a primary objective of the Securities Exchange Act of 1934? A. To regulate the issuance of new securities. B. To establish rules for the initial public offering, IPO, process. C. To regulate the secondary trading of securities and establish the SEC. D. To define the responsibilities of investment advisors. Answer, C. To regulate the secondary trading of securities and establish the SEC. The Securities Exchange Act of 1934 is a landmark piece of legislation designed primarily to regulate the secondary market, where securities are traded after their initial issuance, and to protect investors. A key outcome of this act was the creation of the Securities and Exchange Commission, SEC, the primary regulatory body overseeing the securities industry. In contrast, the Securities Act of 1933 primarily governs the initial issuance of new securities, primary market.